What if I told you that by investing just $100 a month, you could accumulate over $20,000 in just a decade? Yes, you heard that right. We're talking about a significant sum without being a millionaire, without being a financial guru, and practically without lifting a finger. I know what you're thinking. That sounds too good to be true, but I assure you, it's not an exaggeration. This promise is based on one of the most powerful and, at the same time, most underestimated financial principles: compound interest. In this video, I'm going to reveal the secret behind compound interest, explain why consistency is your most powerful weapon, and introduce you to the ideal ETF to make it happen. You'll see clear examples, and most importantly, learn exactly how you can start this journey today. Get ready to transform your mindset about money. Let's start with the basics. What exactly is compound interest? Imagine compound interest like a snowball. At first, it's small, but as it rolls downhill, it picks up more and more snow, and that extra snow also adds to its size. This way, its growth accelerates exponentially. In finance, compound interest is when your earnings, the interest you earn on your initial investment, also start to generate their own earnings. That is, your interest earns interest. You not only get returns on your original capital, but also on the accumulated interest from previous periods. This is the key difference from simple interest, where the snowball doesn't grow. This interest on interest feature is what allegedly led Albert Einstein to call it the most powerful force in the universe. It's not magic, it's pure mathematics applied with a dose of patience. The more time you give your investments, the more impressive the compounding effect will be. That's why time is your most valuable ally. Now, let's turn this theory into concrete numbers. Imagine this scenario. You decide to consistently invest $100 every month, and your investment, on average, achieves a 10% annual growth. This 10% is a reasonable and achievable return in the stock market over the long term. If you maintain this discipline for 10 years, the result will amaze you. You would have contributed a total of $12,000 out of your own pocket. $100 USD x 12 months x 10 years. But your account would show over $20,000. That difference, more than $8,000, is the power of compound interest in action. It's money you earned by simply being consistent. You didn't have to become an expert or analyze charts. You just applied two fundamental keys: time and discipline. The starting point, the art of saving, and why it's vital. Before investing, you need the fuel, saving. It's the foundation upon which you'll build your financial strength. Many people make it a habit to set aside a fixed percentage of their income, 10%, 15%, or more, every time they receive their paycheck. The important thing isn't the initial amount, though $100 is an excellent starting point, but acquiring the habit of consistent saving. Automate it if possible. Have the money transferred to your investment account as soon as you receive it. Pay yourself first. If you think $100 a month seems like a lot, I invite you to reconsider your expenses. How much do you spend on expensive dinners, impulsive purchases, or unused subscriptions? Investing isn't a luxury, it's a conscious decision to prioritize your future. We'll always talk in dollars, the global reference currency. The real magic here isn't how much you invest today, it's doing it every single month. Think of it like going to the gym. One day won't change anything, but going for 5 years changes everything. The same applies to investing. In the first few months, even the first year, you might not notice a drastic change. Your gains might seem insignificant. This is the period where many get discouraged and give up. But those who persevere, those who understand that compound interest is a long-distance race, are the ones who reap the rewards. Your money starts working tirelessly for you, generating more money without you having to lift a finger. You don't need to be a financial expert. You just need a good plan, the right tool, and the discipline to stick to it every month. That's your only task. Now that we understand the mechanics and the importance of consistency, let's talk about the tool that will make all of this possible for you, simply and efficiently. We're talking about ETFs, or exchange-traded funds. More specifically, I want to introduce you to one that I consider ideal for this strategy, the SCHD ETF, managed by Charles Schwab. Why is the SCHD ETF so highly recommended for this mission? Because it brings together a combination of fundamental characteristics that make it a perfect vehicle for long-term investors seeking growth and, above all, passive income. 1. Investments in solid U.S. companies. SCHD doesn't just invest in any company. Its methodology focuses on selecting U.S. companies with a proven track record of consistent and sustainable dividends. Think of names you know and trust, companies that have withstood the test of time and economic crises. This provides a stable foundation for your investment. 2. Consistent and attractive historical performance. While past performance is no guarantee of future results, SCHD's track record is impressive. It has shown capital appreciation and dividend growth superior to many other funds and market indices. Its investment philosophy seeks quality and value, which has historically resulted in good returns. 3. Pays regular dividends. This is the crown jewel for our passive income strategy. SCHD pays dividends quarterly. This means, without you having to sell any of your shares, you receive income periodically. These dividends, if you reinvest them, which I strongly recommend to apply compound interest, automatically buy more shares of the ETF, further accelerating your snowball's growth. To visualize it even better, here's a real example, with historical data up to the cutoff date for this video. If you had the foresight to invest $100 per month in SCHD from January 2013 until today, mid-2025, a period of approximately 12 years, the result would be astonishing. You would have contributed about $14,400 from your own pocket. $100 USD times 12 months times 12 years. But thanks to the growth in the ETF's value, and especially the reinvestment of all those dividends, your investment today would be worth over $29,000. This is an estimate based on SCHD's historically strong performance. That difference, over $14,600, is the pure power of compound interest and dividend reinvestment working for you. And best of all, you did it automatically, stress-free, without complicated decisions. Now, let's talk about something as important as numbers and tools, the investor's psychology. This is where many fail, not due to lack of capital or the right tool, but due to lack of patience and understanding of the process. One of the most common mistakes beginners make is giving up too soon. They get discouraged because, at first, their money's growth doesn't seem as fast as they expected. Or, even more commonly, they panic when the market experiences a downturn. They see their numbers in red, feel like they're losing money, and decide to sell, materializing those losses. But what they don't know is that the nature of compound interest is precisely that. It's slow at the beginning and explosive at the end. Imagine the growth of Chinese bamboo. After planting it, you can spend 5 years watering and caring for it, seeing absolutely nothing above ground. Most people would give up. But in the 5th year, suddenly, it grows 90 feet, 27 meters in 6 weeks. Did it grow in 6 weeks? No, it grew in 5 years and 6 weeks. With your investments, the same thing happens. The first few years are undoubtedly the most psychologically challenging because the difference in your net worth isn't dramatically noticeable. The interest generated is small compared to your contributions. But when you've been investing and reinvesting for 5, 6, 10 years, or even longer, that's when you feel the true unbreakable force of compound interest. Most of the gain, the real boom, comes towards the end of your investment horizon, not at the beginning. Patience isn't just a virtue in investing. It's a financial asset in itself. Don't let emotions guide you. Trust the process. Like all investments, this strategy, while powerful and simple, has its advantages and important considerations. It's crucial for you to know them before starting. Advantages of the SCHD investment strategy and similar ETFs. 1. It's automatic. Once you set up your monthly contributions to your broker, the process of investing in SCHD can be almost completely automatic. Your money gets invested without you having to think about it. 2. Requires no deep technical knowledge. You don't need to be a market analyst. SCHD is a passively managed fund that follows a clear methodology, eliminating the need for you to pick individual stocks or try to beat the market. 3. You can start with little. As we've seen, $100 a month is an excellent starting point. The barrier to entry is low, making it accessible for most people. 4. No need to constantly monitor the market. This is a long-term investment strategy. You don't need to check prices every day or stress over daily economic news. Your focus is consistency and time. 5. It pays. Regular dividends. Receiving periodic income without selling your assets is a huge advantage. These dividends can be an extra cash flow or, ideally, be reinvested to further boost the compound interest effect. 6. Instant diversification. When you invest in an ETF like SCHD, you're not buying a single stock, but a basket of dozens of solid companies. This drastically reduces risk compared to investing in just one company. But you also need to be aware of the risks and considerations. 1. No guarantees. No investment is risk-free. Stock markets go up and down. There will be periods of volatility or even downturns. While historically the market has tended to rise in the long term, there's no guarantee of future returns. 2. Past performance does not guarantee future returns. SCHD has performed excellently, but this doesn't ensure it always will. The economy and companies change. 3. Invest always with clear goals and a defined time horizon. This strategy works best over the long term, 5, 10, 20 years or more. If you need the money in 1 or 2 years, this might not be the most suitable option, as a short-term market downturn could affect your capital. 4. Market risk. The value of SCHD fluctuates with the market. You might see the value of your investment temporarily decrease. Patience is key, and not selling in a panic. This isn't a get-rich-quick scheme. There are no magical shortcuts. It's a proven and secure path to financial freedom, built with small, consistent steps, but with potentially enormous long-term results. Many people wonder, why not just keep my money in a bank account? Or, I'll put it in a fixed deposit, that's safe. And some, more modernized, leave it in an online account without generating interest or with minimal returns. Do you know what all those options have in common? They lose, and a lot, against inflation. Inflation is like a silent thief that steals the purchasing power of your money every day. What you can buy with $100 today might cost you $110 next year. If your money doesn't grow at least at the same rate as inflation, you're actually losing money. In contrast, investing in an ETF like SCHD not only has the potential to protect your capital from inflation, but also to grow it significantly above it. The goal is for your money to work harder than inflation. Besides SCHD, there are other ETF alternatives if you want to diversify or explore other approaches in the future. VTI, Vanguard Total Stock Market ETF. If you want to invest in the entire U.S. stock market, covering everything from the largest to the smallest companies, it's maximum diversification within the U.S. VOO Vanguard S&P 500 ETF. To invest in the 500 largest U.S. companies, which are the heavyweights of the economy. It represents a large portion of the market and is very popular. JP Morgan Equity Premium Income ETF. Another option with a strong focus on generating monthly income through dividends and other strategies. Ideal if your priority is a higher cash flow, though with a slightly different risk profile than SCHD. Each has its particularities, but if you're just starting your investment journey and looking for a simple, powerful strategy with passive income, SCHD is an excellent gateway due to its combination of quality, dividend growth, and relative stability. We've reached the most exciting part. After 10 years, if you followed this strategy with discipline, you'll probably look back, see your investment account grow steadily, and think, why didn't I start sooner? But the reality is, the journey doesn't end there. In fact, it's just the beginning of a new stage. Most likely, far from wanting to stop, you'll want to continue. The inertia of growth and the satisfaction of seeing your money multiply will push you for more. You'll want to increase your monthly contributions. As your income grows or your budget optimizes, you'll want to allocate more to your investment. Reinvest all your dividends. If you're not already doing it automatically, the importance of not spending dividends but reinvesting them will become a priority. Perhaps add other ETFs or individual stocks. With more experience and confidence, you might explore other investment opportunities to diversify even further or seek specific returns. Educate yourself more. You'll want to learn about more advanced strategies, taxes, estate planning, etc. Because the most valuable thing you will have gained in this decade isn't just the sum of money, it's something much deeper. You will have cultivated the habit of consistent investing, confidence in yourself as an investor, and most importantly, the path to financial freedom. You'll be building a legacy for yourself and your future. And now, to wrap things up, I want you to take away one very clear idea. What matters isn't how much money you have today to start. What's truly crucial is what you do with what you have, every month, consistently. $100 a month might seem like a modest amount at first, but with time, patience, and the unmatched power of compound interest, it becomes an unstoppable force for your financial future. So, if you want to stop procrastinating and start building your financial freedom today, check the links I've left for you in the description of this video. You'll find useful resources and links there. Open an account with a reliable brokerage platform. Right here, I'll put a window or an on-screen card to another video where I show you the best platforms to get started. And most importantly, start investing in your future. Take that first step. Remember this fundamental investing quote: the best time to start investing was yesterday, but the second best time is today. Don't put off until tomorrow what your financial future can start earning today. If this video helped you, hit like so YouTube shows it to more people. Subscribe to the channel to join our community of smart investors, and turn on the notification bell so you don't miss any of our upcoming videos on personal finance, investing, and passive income generation. See you in the next video. Your financial future awaits.